Hello guys, welcome back to my channel. Time and money to have the best experiences out of your life. And as discussed in the previous video, check out the video on Mutual Fund 201. In this video, we will discuss what are the factors you should consider before investing in mutual funds and what are the things that you should know before investing in mutual funds and what to research among the mutual funds that you want to select for investing, as well as where to research and what to research in mutual fund investing. That is DIY, do it yourself project, and you will have much more satisfaction than just giving away money to someone else for investing your money. And before I start the video on mutual fund, go check out my Telegram channel where I'm trying to build a community where a group of like-minded people can come together and discuss about personal finance, personal growth, career, and everything in between, and lead each other as well as motivate each other in this journey of life. So first of all, the factor that you should consider for investing in mutual fund will be your goal. That is, what is the goal that you are trying to invest for? And as I have already discussed in my first video, mutual fund investing, many of them might lose track of it, might end up not investing in mutual fund for the long run. And that is mainly because there is nothing for them to keep a track on, or there is no end goal that they are trying to achieve. It might just become a blank slate for you to keep on investing without end goal, and many of us might lose sight of it and might end up stopping investing in these funds. And for you to be on track to invest in this, what you will have to do is keep an end goal, and this goal can differ from each and every one of us. For a few of us, goals could be in terms of the short term goals of buying a vehicle or going for that domestic trip, and medium term could be going for that international tour that you always desire to have, and it could also be some nice experiences that you wanted to have. There is no restriction on the way you wanted to use your money. It could be for retirement fund, enjoyment fund, or even for that matter something as a cushion for you to take that plunge into the dream that you wanted to pursue, that startup you wanted to start, that business you wanted to start, etc. And then after this goal, the thing that is related to this and you will have to keep in mind is basically the tenure or the term that you're trying to invest for. Is it something that you're trying to invest for some short term goal, or medium term or long term goal, and basically the time horizon related to this. And this is very important because in the short term there are few funds that you should invest in, because if you invest in equities, there is no guarantee that your money will be constant and it will be safe. That is, more specifically, money keeps on fluctuating a lot, especially in equity funds. Hence, for short term, it's better to invest in liquid funds, something like government bonds, AAA rated corporate bonds, etc. And similarly, medium term can be a combination of equity plus debt, wherein really big blue chip companies can be something that you can invest for. And if you have a time horizon of very long term, you can think of investing in small cap, mid cap, and large cap and equity based mutual fund, so that the risk is higher, but proportionately the return that you can expect is significantly higher when you compare to other sort of funds. And next point you should consider is risk. That is, there is no standard definition of what risk means and how much each and every one of us can bear. There are few people who are comfortable in dealing in high amount of risk, and similarly there are few who do not want to bear any risk. Something like fixed deposit saving, even though the return are quite low, it's pretty much guaranteed. And imagine this for a huge chunk of money that you're planning to invest and something that you want to build your wealth with. And if you're not at peace with the money that you're investing and the risk that you will have to bear, both these go hand in hand and are correlated. If you're not at peace with these topics, then it will become very difficult. You might be at crossroads when, let's say, equity markets go down 30, 40, 50% in adverse scenario. You will be at shock and you will not be able to bear that. Even though it's a notional loss, many people just can't digest this concept. And the next point that is related to this is your age. That is, even though many people have different risk capacity at different point in time, it is suggested, again this is no hard and fast rule, when you're younger you can tend to take a higher risk. That is because of multiple reasons. One is there is time at your hand and you have a very long term horizon for you to invest, and because of that you can take that call to take higher risk for potentially higher return. And similarly, the other way is because you are young, you have a very long term for you to earn that extra money. In worst case scenario, the money that you have invested, if it goes down by certain percentage, you will have time to recoup and rebuild your wealth not just through this investment but also by working in your regular job, your business, or any other side hustles that you do. So because of that, when you are younger, it is suggested to take higher risk. Again, contact your financial advisor for much more in-depth clarification. This is a suggestion and something that you can think about. And when I'm talking about retirement, it is not something just in a traditional manner wherein when you approach your 60s or late 50s is when you are aiming for retirement. It also means the new concept that people are striving for, that is early retirement, and people are saving towards trying to achieve that and achieve financial freedom. At least even in those cases when you are nearing that retirement goal, you might want to switch your investment to a little more safer side, because as I said again earlier, equities are no way guaranteed or are very high risk investments, and because of that your investment can go up or down by a significant amount and percentage in just a jiffy. And you do not want to base your retirement and the money that you will need for surviving your life on these fluctuations. And the investment in these high risk category can be for something that is for long term, and for your short term to meet your day to day goals, it is ideal to move it to safer investment options. And when we are at this juncture, we have to note how is it that you want to invest your money. That is both how much to invest as well as allocation. These are two critical factors that will impact how you will achieve your retirement and the time horizon that you have available. And as you know, in compounding interest formula, the time is a exponential factor and other all are either a sum or a multiplicating factor. So that extra time you have is what is going to help you to generate that additional and extraordinary return. And on this point, let's first discuss about how much to invest. And if you're an avid watcher of my channel as well as a subscriber, you would have heard me talking about 50-30-20 rule. This is a commonly talked rule in finance world, rather personal finance world, wherein they say when you are at a earning capacity on an average level, you can spend up to 50% of your income on the needs and 30% on wants and 20% on investments. That is 20% is bare minimum. Ideally you should try to flip it, that is 50% to your investment, 30% on your needs and 20% on wants. Again, this depends on various people's investments as well as lifestyle. You can decide how much to invest. And again, as I'm saying, 20% is a bare minimum that you should target for starting to invest in various asset classes. Maybe not just mutual funds, various other asset classes that you can think about. And similarly, start inculcating that habit of investment and trying to get a financial freedom. And similarly, sky is the goal. You can invest 99% of your income, but for that you need to earn that amount of wealth so that your lifestyle can be sustained in 1%. And again, this might not be possible for many of us, but again, once you might be able to reach to that turning point, this might be possible. And on the point of allocation, you can allocate your money to various funds in mutual fund. And again, this can be a combination of various stuff that we discussed earlier. That is the goal that you're investing for, the time horizon that you're investing for, the risk capacity that you're ready to take, your age factor, etc. Basis this, you can allocate your money in various different mutual fund categories. That is, if you're someone who is ready to take a higher risk, then you can allocate 75 to 80% of your investments in equity based mutual funds. And again, in this, you can allocate it into international mutual fund investment plus domestic mutual fund investment. And similarly, mid cap, small cap, large cap, and sectoral based like IT fund, automobile fund, and then pharma fund, etc. And similar to that, if it is something that you are trying to invest or aim for a goal for short to medium term, then you can invest in maybe large cap fund or some debt funds. That is for a very short term period. You can invest in government bonds as well as corporate bonds so that they are relatively safer return, but you can expect to earn a slightly higher return when compared to your FDs. And similarly, allocation can also be basis the market sentiment and mood. That is, if market is too crazy and everyone is greedy, that is market is too expensive and valuations are too high, then at that point you can think of moving 75% of your money towards debt fund and 25% towards equity. That is because at the peak of equity market, especially when they're exorbitantly high, it has happened many a times that market corrects by few percentage. It might be 5-10% or sometimes even 20-30%. So in such a scenario, when market falls, you can again switch this back to 25-75, that is 25% towards the debt and rest towards equity market. And when you are at a crossroad and think that you need some more time, you can keep it at 50-50%, that is 50% debt, 50% equity. But this is a more nuanced way of investing, and for most of them this might not be something that you will be able to grasp easily. Hence, in those cases, you can just continue to invest in equity funds for long term horizon and debt funds for short term, and a combination of these for medium term goals that you have. And because of this, for most of the scenarios, around 90%, this will suffice and help you to achieve the goal you have. And again, I'm saying, for much more professional advice, contact your financial advisor. And because this video can get very long, I just introduce you to the websites that you can refer to for doing your mutual fund research. I'll link down two websites, that is, first is Money Control and Ticker Tip. And similarly, I'll link down few more websites which you can check. And in next video, that is part 2 of this video, we will go on to the screen of my laptop and see what are the funds that you can invest in, how to research, and what are the categories, and everything that we talked about till now. The practical application as well as seeing how we can invest is something that you can look out for. So ensure to stick around as well as subscribe to the channel and like my video, as well as check out the Telegram channel, and you can have a discussion with me personally one-on-one. I would like to see you on the Telegram channel, as well as subscribe down and help build and grow this community. See you soon.